Imagine this: you wake up one morning, check your phone, and see that a stock you bought last week has doubled overnight. Headlines scream, "The next big thing." Your friends are texting you screenshots of their gains. It feels like you've cracked the code to instant wealth. You're elated, almost dizzy from the rush. But the thrill doesn't last. By the end of the day, the stock crashes. Overnight, your gains vanish, replaced by panic and confusion. You wonder, how could this happen so fast? This isn't a rare story. Every day, countless investors fall into the same trap, chasing hype instead of building real, lasting strength in their portfolios. Today, I'll show you why focusing on solid, sustainable companies beat hype every single time, and how to build a portfolio that grows quietly but powerfully, without the stress and drama of speculative trends. Number 8. The danger of speculative stocks. Speculative stocks are like fireworks, dazzling, loud, and exciting, but just as likely to burn out quickly. These are companies that promise huge upside, but have little to no proven track record. They might be new tech startups with revolutionary ideas, biotech firms awaiting regulatory approval, or tiny energy companies exploring untapped markets. At first glance, the potential seems limitless. Investors are drawn to their sky-high potential because, in the back of their minds, everyone dreams of that one big payday. But here's the problem: these companies are fragile. They can rise on rumors, predictions, or investor sentiment, but one missed milestone, one regulatory hiccup, and their stock can collapse. Take a hypothetical biotech company developing a new drug. News breaks that their trial results are delayed. Overnight, the stock tumbles 60%. Investors who were dreaming of gains are now grappling with sudden losses. Speculative stocks might offer excitement, but they often carry the heart-pounding stress of gambling rather than the calm confidence of investing. The lesson is clear: speculation isn't building wealth, it's chasing luck. And luck, as thrilling as it feels in the moment, rarely leads to sustainable growth. Number 7. Meme investing, the social media mirage. Now let's talk about something even stranger: meme investing. This is when entire communities on Reddit, TikTok, or Twitter band together to push a stock sky high, not because the company is profitable or growing, but because it's trendy. Remember the GameStop phenomenon? Ordinary investors rallied behind a stock purely as a social movement. Prices soared 1,700% in days. Everyone wanted in. It felt like winning against the system. But when the media frenzy faded, the stock crashed, leaving many holding massive losses. Meme investing is addictive because it's emotional. You feel like part of a movement. There's a thrill in watching numbers jump minute by minute. You get sucked in by the fear of missing out, buying at the very peak, hoping for the next surge. But the harsh truth is that these gains are rarely sustainable. The moment the crowd loses interest, the stock plummets. This is why building a portfolio around hype is dangerous. You might ride a wave for a short while, but when it crashes, there's nothing to hold on to. Meme investing is fun like a roller coaster, but it's not a foundation for financial security. Number 6. The power of strength, sustainable, dominant businesses. Contrast that with strength investing, the steady, disciplined approach. Strength doesn't grab headlines. It doesn't explode overnight, but it survives, thrives, and compounds wealth over time. Strong companies share several key characteristics: proven profitability. They generate reliable cash flow and earnings. You can look at their financials and see consistent growth. Market dominance. They have a competitive edge that protects them from competitors' brand loyalty, patented technology, or unmatched distribution networks. Resilience. They can weather economic downturns, changes in consumer behavior, or unexpected crises. Think of companies like Microsoft or Johnson & Johnson. They didn't dominate their industries overnight. They grew steadily, reinvesting profits, innovating when necessary, and adapting to market shifts. Their stocks don't skyrocket on hype, they grow quietly, but consistently. Over years, this compounding effect turns a modest investment into significant wealth. Investing in strength is like planting a tree. You water it, nurture it, and watch it grow taller year after year. Unlike a flashy meme stock, it won't fall apart when a rumor spreads or a trend fades. Number 5. Building your portfolio around strength. So, how do you build a portfolio around strength instead of hype? Here's the step-by-step approach. 1. Analyze fundamentals. Look for revenue growth, profitability, debt levels, and a clear competitive advantage. Avoid companies whose appeal is only in social media posts or sensational headlines. 2. Diversify across sectors. Even strong companies can face sector-specific challenges. Spread your investments across technology, healthcare, consumer goods, and other resilient industries. 3. Adopt a long-term mindset. Strength investing requires patience. Ignore the daily market noise. Compounding works best when you let it play out over years, not days or weeks. 4. Reinvest and review. Reinvest dividends and periodically check your holdings. Strong companies can falter if they lose focus, so stay vigilant. By following these principles, you're building a portfolio that can withstand shocks, trends, and market hype. You're not chasing adrenaline, you're building lasting wealth. Number 4. Avoiding the hype trap. Even with a strong strategy, the market constantly tempts you. Hype comes in subtle forms. Headlines screaming, "The next 10x stock." Friends or influencers urging you to buy now, social media communities pushing stocks to absurd highs every time you feel the urge to follow the crowd. Pause. Ask yourself, would I buy this if no one was talking about it online? If the answer is no, it doesn't belong in your portfolio. It's a simple mental trick, but it saves investors from emotional decisions that lead to massive losses. Strength-based investing isn't about chasing the trend, it's about staying disciplined while the crowd chases excitement. Number 3. A tale of two investors. Let's illustrate this with two hypothetical investors. Investor A is drawn to a viral stock. They buy at the peak, riding the social media frenzy. For a brief moment, the numbers soar, but then reality hits. The stock collapses. Panic sets in. Investor A sells at a loss, discouraged and burned. Investor B chooses a strong, profitable tech company. They experience no dramatic spikes, but the stock grows steadily 10 to 15% annually. There's no rush, no panic, no chaos. Over 5 years, the portfolio compounds quietly, growing far more than any hype-driven gamble could. Which strategy leads to real financial security? The answer is clear. Strength-based investing wins over time because it prioritizes sustainability over spectacle. Number 2. The psychological edge of strength investing. Strength investing also gives you peace of mind. When your portfolio is built on solid foundations, you don't wake up in a panic every time the market dips. You sleep well, knowing your investments are resilient. Speculative and meme-driven investing creates constant anxiety. You're reacting to social media, rumors, and fear of missing out. Your wealth depends on chance, not strategy. Strength investing, on the other hand, empowers you. You make decisions based on research, not hype. You focus on what you can control: fundamentals, diversification, and patience. Over time, this psychological edge compounds too. Confidence in your strategy prevents rash decisions, allowing your portfolio to grow steadily. Number 1. The secret to long-term wealth. Here's the secret the top investors know. The market rewards patience more than hype. Those who chase instant gains are constantly at the mercy of market swings. Those who focus on strength, however, let compounding do the heavy lifting. Consider this $10,000 investments in a strong, dominant company growing at 10% per year will more than double in 8 years. A speculative stock might double in a week or vanish entirely in a day. Which outcome would you rather rely on? Strength investing is boring on the surface, but boring is beautiful when it comes to wealth building. It's predictable, reliable, and ultimately far more rewarding than chasing the next viral stock tip. And that's the secret, building a portfolio around strength, not hype. Remember, slow and steady wins the wealth race, and patience is your most powerful tool in the market. If you found this video helpful, don't forget to hit the like button. It really helps support the channel and lets me know you want more tips like these. And if you haven't already, subscribe and turn on notifications so you never miss a video on investing smarter, avoiding hype traps, and growing your financial future the right way. Drop a comment below and tell me, which strategy do you use: chasing the next viral stock or building strength for the long term? I'd love to hear your thoughts. Stay patient, stay disciplined, and I'll see you in the next video.